Good evening, friends. Welcome to Dirty Economics webinar on Nifty Outlook for end of the day outlook, and we'll have a quick look at the Nifty chart and discuss the key event risk or the macro risk that lie ahead for us, and we'll also have a brief look at the dollar rupee exchange rate. So let's go ahead. Points to be noted. There's a big event risk ahead. We have Fed's Yellen speech at the Jackson Hole event on Friday, and if you look at the market reaction from the beginning of this week, early on in the Asian session on Monday, Treasury yields rallied, and it means the Treasury prices dropped and yields rallied, especially at the short end of the yield curve. That is the 2-year Treasury yield, which is closely related to short-term rate hike bets in the US. It strengthened, dollar strengthened, gold and silver dipped, and so the early reaction suggested that markets were preparing ground for hawkish Yellen. However, as the week progressed, yesterday and even today, the dollar is somewhat on the back foot. So that forces us to consider that maybe just Yellen would come out neutral, like the policy statement that we have had. But there is a that should be noted, that gold and silver aren't showing any signs of life, even if the dollar takes a hit against other major currencies like New Zealand dollar or British pound, which is is in a corrective mode. Japanese yen uh, is also working hard, to take the dollar yen pair below 100. So overall, if you look, even if in the currency markets, dollar is being offered, gold and silver aren't really showing any kind of interest. So the odds are, looking at the market reaction, I feel the odds are that we may have Yellen come out hawkish, slightly hawkish. Her colleagues, her closest colleagues, Stanley Fisher and Dudley, they have been hawkish of late. And when you compare Yellen's stance to their, Yellen appears relatively dovish, and surely she has some catch-up job to do. And that is the reason I feel there's a possibility that Yellen would come out slightly hawkish, and Fed would want to keep giving feelers to the market that rate hike could indeed happen in December. There are still major investment banks out there who say the markets are underpricing the possibility of or underappreciating the possibility of a rate hike this year. So December still, reluctantly, markets have to accept, or grudgingly they have to accept the fact that December rate hike is still on the table. And so that is the event risk. So the risk to Nifty is obviously, if Yellen drops a hawkish bomb, equity markets are likely to suffer, and dollar rupee is likely to spike in the next week. And then you have something called a September seasonality, that if you look at the action in the S&P 500 since 1928, then September turns out to be the weakest month. 50%, 56% of time September has turned out to be a weakest month. Note that this period between June, July, August, and September, these 4 months, especially July, August, and September, are usually the period of turmoil for the global markets. But we had a brief turmoil, Brexit turmoil, on June 24th this year, which was quickly undone, and since then it has been, just everything has been just hunky dory for markets. So August is almost through, and we have not had any big sort of risk of events. Everything is very calm. However, there's another month to go, that is September, and in case Yellen drops a hawkish bomb, then S&P 500 could retreat, and it could actually follow the seasonality pattern that I've just mentioned over here. So these are the two key event risks in my key points that one has to take note of. Proceeding further, this is a Nifty daily chart I have, and as the title suggested, there's signs of exhaustion in Nifty. Indeed, there are. If you see on the daily chart, the daily RSI is producing lower tops, while the price chart is still pretty much producing higher bottoms. Though it is a flat, the trend line is a bit flat, and we also have. What appears to be a sort of a symmetrical triangle formation, in progress, and we have a larger trend line resistance. Plus, we have a 50-day moving average of it, which comes around 85, 84, 80 levels as of now, and there are clear-cut signs of exhaustion. The GST bill was passed, but the news was pretty much priced in advance, and uh, the markets don't really rally on the known facts. So it wasn't any surprise this time around. So there was no rally. As of now, as the title suggests, there are signs of exhaustion, and the bearish price RSI divergence should come into play, or could come into play. But overall bullish invalidation is seen only if prices breach the rising trend line. So currently, for me, this is a no trading zone. If indeed I have to trade, I would rather try and buy options, especially calls. Sorry, I meant to say especially long straddle and long strangle. Selling options at this point of time is very, very risky, simply because the uh, VIX is extremely low, and if you sell options over here, even if you decide to sell call, higher calls, expecting that if market has a market suffers from risk aversion, you'll make a lot of money on short calls. But the spike in volatility is likely to keep the value of the option somewhat intact. So selling options at this moment is not advisable. Buying option is, you can buy a September straddle or September strangle for that matter. Otherwise, you can just buy short a future and buy a 50 point or 100 point in the money call, just to act as a hedge. So these are some of the option based or future and option based strategies that one can execute. On the higher side, unless and until we don't see a convincing close above 80, let's say around close 8750 or so, uh, there's no point in initiating fresh long trades. So that's the outlook on Nifty, and I would just like to s- give a brief outlook on the USD INR. If we zoom into the chart, USD INR too, like Nifty, has turned sideways, and it's a sort of a symmetrical triangle. And the 50 DMA support, you know, 50 DMA support comes around 66.71 levels, and it's currently sitting around 67.10. Pretty much, there's no clear cut trading signal as of now. I would try attempt going long. If I see a break above 67.41, which is the July last week of July, high of July 25, and in that case, we could go back to 68 levels. On the other hand, if I see a weekly close below 66.70, that would be a major sell signal for me. So that's pretty much for the day, and I shall see you tomorrow.